You can't take it with you when you're gone, so how do you make the most of it while you are here? It's time for Your Money Matters with Sam and Dieter from Harness Financial.
Sam and Dieter both in the studio. Nice to see you again, guys. Do you get excited as financial advisors and helps you get excited about the budget as like a big days like the FA Cup final for you?
No, because your long-term planning is you kind of react to short-term stuff like that. So it's good to know what's happening.
Yeah.
But fundamentals stay the same.
Just another day. All right.
Yeah.
Do you stay home and do you watch the budget in the office, Sam? No.
I never have. Have.
Okay.
Hey, what's this folding stuff
That
you're
was-
referring to?
I said it, and as I said it, I thought, when did I last? I've been travelling a bit, so I've had a bit of folding currency.
Yeah.
But you're right, I don't carry any cash. I don't carry cash at all anymore. At all, because you just always wave the card or something. Well, now just wave your phone, don't you?
Oh, wave your watch, wave
Or
anything.
Yeah, that's right. Well, I just wave and say, I can't pay for that. Bye. Look, I hate rules, but and I've never heard of this one before, but you're going to...
Really?
No, I've never heard of it before.
Okay.
So you're going to school me, and I imagine a lot of our listeners. By the way, if you've got a question, you can text in, you can ring in, and you can ask the guys. We'll put you on hold. We've got the phone lines open for this. You're going to tell me about, what, the 4% rule?
Yes, that's right. That's right. The 4% rule in investment management or investing. It's a term of jargon that's thrown around a lot. And even just yesterday, I was reading a book about personal productivity, and there was a reference to the 4% rule. I think a lot of people listening would have heard of the 4% rule.
Yeah, not me, sorry.
You haven't, no, Sean, but I'm sure someone's mentioned it to you at some point. What on earth is the 4% rule, Dieter? What does it refer to?
So this is really exciting academic sort of based stuff. The 4% portfolio drawdown rule. So it's basically the amount of money that you can safely draw from a property structured investment on a yearly basis without actually depleting capital, offsetting long-term inflation, and basically have an income that you can live off.
What does it mean to deplete capital? What is capital?
Well, the capital is the big lump of money that you've got either invested or property or something else where it's got to generate an income. So it's your net assets, basically.
Okay, so the rule of thumb is you've got a return producing whatever, piece of property, investment, stock, bond. You should never take away more than 4% of its value or of its income. What's the 4% of?
So the 4%, so this is specifically looking at things like managed funds, diversified funds. So if you had $1 million portfolio, you could draw down $40,000 a year of that. Property is different because you're limited to your rent, less expenses, less tax.
Yeah.
That 4% is not a taxable income. So if that $40,000 is what you get in your bank account, paid on a regular basis.
Yeah.
The 4% rule only works if the structure is correct. So an example of where, and I should have said this at the start, this is general chat, not personalised advice, but an example of where the 4% rule will absolutely not work is if you have all your money, so you got $1 million or $2 million in term deposits. Why would that not work, Dieter?
So basically, if you draw down that percentage that it pays you in interest, your capital is not growing. So your inflation will slowly erode the actual capital value. So inflation is that invisible worm that eats away at the value of your money.
So the 4% is a post-inflation adjustment for inflation figure.
Yeah, so every year that 4% adjusts to whatever that portfolio is over time.
Yeah.
But as that portfolio grows, your 4%
Now you
money-wise
call
will
this
grow.
a rule. Is it in fact an aspiration that when you're looking at an investment to provide for a retirement income or some sort of annual income to supplement super or whatever else you're getting, that you should be aiming to get 4%, or that's a reasonable thing to expect? So I'm trying to find the difference between a rule and a convention.
Well, it's a conservative rule.
Okay.
So you can expand on that, Dieter.
Yeah, so basically this was done by study in the US by a financial planner there, and it was later verified by Trinity University. And it assumes a 30-year retirement horizon. It relies on historical, specifically US market returns, stocks and bonds. It accounts for inflation, and you're not trying to be super aggressive. So this is a balanced growth portfolio. And that will, over the long term, generate enough returns to pay the tax, to cover inflation, and have the 4% income paid to you.
Okay. All right. So it's a way of setting some parameters to plan for your future. And you guys obviously use it, the 4% rule.
I do. Now, there's one important caveat to this, and that is markets, as we've seen recently, take their long-term dips.
Yeah.
So outside of the portfolio, I would always recommend 2 years worth of your income top-up in a cash reserve.
Right.
So when the markets do hit the fan, you can stop drawing from that portfolio and you can use your cash reserve to basically supplement income. When the portfolio goes up and stocks go up, then you can start the income again. What you don't want to do is be drawing down when the market is really low, because then you're crystallizing
I get you.
low prices.
Yeah. Okay. Geez, it's okay. So I now know what the 4% rule is. Just another for me to worry about and put my hands up in the air. When you are putting together a plan for people, are these the sort of things you're constantly factoring in when you geez, anything I learn from you, got to have a plan of what you want. These are the sort of things you factor in when you're looking at a plan that stretches out for some people, 20, 30, 40 years?
20, 30 years plus. I mean, there's a lot of medicines keeping us alive. So your timeline needs to be factored in. And that's also for two people. So even if one person passed away, one of them was going to live for 30 years.
Yeah.
In most cases. And
should we talk about what a typical plan looks like in terms of the buckets? You mentioned cash, and there's two types of cash. There's liquid cash, and then there's also term deposits. Can you talk about those buckets and then the other buckets and how you end up with the 4% rule?
Well, I suppose it's appropriate with the rain on the way.
Yeah.
So generally I work on three buckets.
Yep.
You've got your emergency income reserve fund, which is a purely cash fund, or term deposit, doesn't matter. You then have a lower risk fund, which is more bond focused, which is your sort of medium term horizon.
What is a bond?
A bond is basically a piece of paper that whoever issues the bond will pay you a coupon rate every year based on the value of that bond.
Okay.
Yeah.
And they work up just as a side. It operates opposite to interest rates.
Yeah.
So interest rates go up, the value of bonds go down,
And vice versa.
vice versa.
All right. Have you guys been getting many people freaking out about their Kiwi Saver? I've stopped looking. I just stopped looking. There's nothing I can do about it. It is what it is. I'm in the best fund I can find for me. But I did have a couple of weeks after the tariff thing, and I just thought, I can't do this to myself anymore. Do you get reaction from clients who might see something short-term going wrong in a portfolio or something set up for you, and do they ring in a panic?
I've had one client contact me, and I said, this is a fantastic time.
Yeah.
Keep on going. Every contribution you put into your Kiwi Saver is buying at discount. So forget about the balance.
Yeah.
Focus on what you're purchasing with your contributions.
Yeah.
So if you're purchasing, and we won't use Briscoes because they always have a sale, but if you think about a day in New Zealand where there's suddenly Black Friday, you're buying in at Black Friday prices. So the longer you can do that, the better the long-term benefit.
So it's not all bad news, I don't need to jump off the sidewalk.
Well, you can plan for these times.
Yeah, that's right. And that's when we get back to talking about the plan. Are you going to get... Look, I asked the question about the budget for a reason. Once again, it's the thing about short-term worry and plan, and the idea, I guess, is to come in guys like you. If you see something going wrong for a client, or you've set something up for a client, and something happens that would affect them, would you contact them and say, hey, guys, we probably need to rejig this? Is that part of the service you guys provide?
It is part of that service, but the really important time to do that is when you set it up.
Yep.
So when you set it up, you already plan for these markets. You already plan for things to go a bit sideways.
Yeah.
And because it will.
Yeah.
And it'll happen again and again. But long term, you will still have growth. But you've got to have the right sales for the right wins.
All right.
And so you leave the harbour already planned for the storm.
Yep. All right. How do people get hold of you guys?
Well,
www.harnessfinancial.co.nz,
or just Google search Harness Financial.
That's right.
People,
we come up. And should you wish to seek us out for insurance advice, income protection, life insurance, health insurance, all those good things, ACC advice, call me, Sam, on 027 334 4812. But the cooler, the sexier part of the business is the investment advice and the retirement planning, managed funds. Bucket 3, managed funds.
Yeah.
And your number, Dieter, is
021 0268 7955.
All right. Look, I might get you guys in after the budget because you're not too invested in it to have a chat about it, because I don't really have a budget expert that isn't a quite pointy-headed economist.
Yeah.
And I quite like somebody who's a bit more practical to talk about it. So, look, let's do that after the budget. I'll look at the timing for that. As always, a pleasure, guys. A little bit quiet on the phones this morning. I think people are out looking for their umbrellas all over the country right now, to be honest. Oh, we got one in. A plan for your health. It's really important, in my opinion, as we have found out, says Andrew. We were just talking about that. We now have enough people maybe to do a group insurance scheme at the platform. I've got one person, but I need to be able to put a proposal to them because it will be good for lots of people in this organisation. And you do a great deal on that, I know.
Maybe we could help platform people with their Kiwi Savers too, couldn't we?
Yeah.
Yeah.
Yep.
Yeah. I just try not to panic on my Kiwi Saver. Thank you, guys. We will see you in a fortnight.
Thanks, Sean.
Thanks, Sean.
Your Money Matters with Sam and Dieter from Harness Financial. To make the most out of your money, visit harnessfinancial.co.nz.